Recently, Deutsche Bank released a new survey of professional investors saying that the vast majority expect interest rate hikes to cause more financial, quote, accidents, by which they mean financial markets crashing. Nearly all respondents expected more of these, with most thinking the accidents will be contained, in other words, bailed out, while 1 in 5 expect financial accidents that governments will fail to contain. Now, I'm not sure governments using endless stimulus and permanent bailouts to make banks and markets fragile and then going on to break them qualifies as accidents, but whatever they are, professional investors are expecting more of them. In fact, we've already seen storms in multiple countries around the world. The UK pound hit near third world levels of interest on government bonds last year, almost putting the pound below parity with the dollar and threatening to bankrupt some of Britain's largest pension funds. Meanwhile, the Japanese yen has plunged almost 30% in the past 18 months, forcing the central bank to buy up a majority of Japan's $10 trillion in government debt. Keep in mind, Japan's economy is about 5 times smaller than the U.S., so that's equivalent to over $50 trillion in federal debt in American terms, with most of that bought up by the central bank. Meanwhile, China is swimming in similar debt levels to Japan, raising fears of a Japan-style long depression even in China. In fact, here at home, even before COVID, our own bloated Federal Reserve was leaving trillion-dollar accidents on the street, from the repo crash of 2019 to, of course, the most recent bank crashes beginning in March. A few days ago, the Wall Street Journal ran an article laying out 5 kinds of accidents that could be on the horizon, driven by frothy stock markets paired with falling profits, higher rates, and a very ominous yield curve, that horseman of financial apocalypse that I talked about in a recent video. Taken together, the journal worries that U.S. financial markets, quote, could be vulnerable to a rapid reversal. They note that just 8 tech stocks now make up 30% of the S&P 500, making markets fragile to a miss from any one of them, at which point you can get a rush for the exits that magnifies any drop. And given that U.S. stock markets represent about $40 trillion in wealth, that would hit both households who use Wall Street as a retirement fund, as well as banks and regular companies who park trillions of assets in stocks. The other day I mentioned that given the weak economy, stock markets increasingly feel like picking up dimes in front of steamrollers. Yet, as the journal complains, FOMO, fear of missing out, continues to plow more money into the firing line, meaning that when those accidents come, millions of smaller investors and families will get hit, at which point they pull in their horns, they cut spending to pay down debt, make ends meet, and they join the recession. So what is next? In the famous words of Benjamin Graham, in the long run, the market is a weighing machine, but in the short run, it is a voting machine. So we do not know what is coming in the near term. These next few months will be a cage fight between fear of missing out and FUD, fear, uncertainty, and doubt. And so we all must invest accordingly. Okay, we'll be watching. See you next time.